Welcome friends. In this class on the paper Strategic Advanced Financial Management, I, CA Ashish Gupta, Joint Director Board of Studies, welcomes you. Students, as you have attended our last class where we were discussing our first topic, chapter Financial Policy and Strategic Management. So here today I am continuing the same session, only there are some assignment questions have been left. So in the initial part of discussion, I will cover the remaining questions of the first assignment. Then I will take up the chapter number second, that is risk management. Now student, when we talk about the topic number one, there was one topic, external funding requirement, on which we have covered theoretical aspect, and as well as we have started one numerical question, question number two. So there are in this question there are three type of scenarios were there. First scenario we have covered in the earlier class. Now today we shall continue with our second scenario. After that I will take up the next scenario. I'll just hold for a second. Now student, before your screen there is let me check some changes there. Good morning, madam. Okay. Now on the screen, there was question number two. Okay, the following data pertains to ABC Limited. Okay, so balance sheet we have covered here, seen here. Income statement was there. Okay, now first case scenario we have covered where there was an increase in the sales by 15%, and then it was asking for what would be the modified income statement. Okay, so here we have covered, we have to prepare one revised balance sheet and analyze the external funding requirement under three categories. First, it was a no change in fixed asset and in proportion to sales, and no dividend is declared. Okay, so we have seen when there is no dividend is going to be declared and there is no change in fixed asset. So what was our requirement? Now I am taking up the second case scenario. Okay, the income statement will remain the same for all three cases. Only the balance sheet will change. In this scenario, the condition is that, one second. In this scenario, the condition is that the change in the total assets in the proportion of sales and no dividend is declared. So accordingly, we shall consider the change in the total assets, that is fixed as well as current assets. Okay, student. Now let us start adding one by one item. Students, now first here that asset type we are showing, amount is there. Here it is liabilities. Okay, now here first of all I take the net fixed assets. Since there is an increase of 15%, Earlier figure was 24 lakh 60,000. Now this figure comes 28 lakh 29,000. Okay, student. Now next figure I am taking current assets. Okay, this figure is up by 15%. Okay, so cash figure will change to 4 lakh 200 as in our previous scenario. One second. One second. Okay, bills receivable. And this is figure comes 9 lakh 19 lakh 52,700. And here it is a closing stock 17 lakh 18,100. So overall figure comes 69 lakh. Student, you can also observe that the asset side total of the balance sheet is 60 lakh earlier. Now with the increase in both current as well as fixed assets by 15%, there will be overall increase of 9 lakhs. Accordingly, the new figure comes 69 lakh. Okay, now let's start one by one item. Equity 45 lakh. Okay, since no dividend is declared, so whatever with our retained earning, it is here. Okay, right now I am not writing the long-term debts. I am writing here current liabilities. Okay, so here the accounts payable. Increase amount 143 750. Outstanding expenses 51 750. Okay, since we have to tally the balance sheet, I am writing here 69 lakh. Now what I will do here, the long-term debt will be balancing figure. Okay, the amount comes 4 lakh 80,000 595. Okay, student. Now let us see how we have arrived this figure by using the formula based approach, as well as we can also use the logical approach. Now, when we use the formula based approach, I am writing here again the formula, no problem. Okay, now here I have to put the figure of increase in total assets. 9 lakh is there, as I told you, that is the balance sheet total was 60 lakh. Now with the 50% increase, it comes 9 lakh. Okay, liability increase is our overall, whatever the increase here, 25,500. Okay, since there is no dividend is declared. So whatever with our profit that has been retained. Okay, so our figure comes negative 8,49,405. Since our existing debt figure already is 13,30,000, out of which we have refunded this amount, the amount comes 4,80,595. So here we can see the same amount is there and same amount is there. Okay, student. Logically, if I say that I'm putting the logic here. Increase in 1 second. Increase in current assets and fixed assets. Okay, it is 9 lakh. Okay, a part of is financed by current liabilities, that is 25,500. Okay, so accordingly, the balance that overall increase in is 74 lakh 500. Okay, now since we have earned, we have retained earning of 70 lakh 17 lakh 23,905. Okay, a part of it is used for increase in asset, that is here. The balance will be 8,49,405 will be refund of debt. Okay, student. So with this, I hope the case scenario is clear to you. Now I am coming to the case scenario 3. In the case scenario 3, it says change in the total assets in the proportion of sales and 50% of profit is declared as dividend. So it is one of the additional rider. Okay, let me check. Is there any query? Okay, Ginny Ojha, good morning, beta. Okay, now I am considering the case scenario 3. Now modified balance sheet, how we will prepare, you let us see. Now here the left assets are there. Okay, here the liabilities are there. Okay, as usual, like our case scenario number 2, our net fixed assets 15% with increase. Okay, Mamta, I will reply your query. Just hold for some time. This is current assets. Again, 15% increase. Cash. Bills receivable. And closing stock. So total comes here 69 lakh. Now here we start with the equity. Now here retained earning, it says the 50% will be declared as dividend. So if I see my modified income statement, the amount comes 17,23,905. Accordingly, the 50% of the same amount is stand refunded in the not refunded, it is in the form of dividend. So leftover will be 8,61,953. Okay. Now similarly, I am coming here. I'm just writing here the current liabilities. Okay, so here the accounts payable. Outstanding expenses. This is not 6. Let me. It is 51,750. Okay, so total I write here 69 lakh. Now I come to the balancing figure. Long-term debt. It is a balancing figure. Okay, the amount comes 13 lakh 42,547. Okay, student. Now here you will see one thing. My earlier, if I see to the question, okay, if I go to the question, my figure was 13 lakh 30,000. Now my figure is 13 lakh 42,547. So it means there is some addition in the external funding. Okay, there is some addition in the external funding in the form of debt. Okay, student. So now let us see. We compute it by the logic as well. Okay, I'm just using the formula here. Okay, I'm not writing the formula again here. So EFR change in overall asset is 9 lakh. Okay, and minus change in current liabilities is 25 lakh 1,500. Now here I am paying the dividend of 8,61,950, 3 or 2. Okay, if I write here 2, it will be appropriate because I think here I am writing retained earning as 953. My profit was here 905. Okay, so accordingly, I write the here figure 92. Okay, this much of dividend amount I have declared. Okay, accordingly, my AFR comes. Okay, so this much of amount I have raised from the uh, outside, from the outside. Okay, there may be some rounding of difference, student. You can do it by zero point 0.5. It hardly matters. Even you can take here 3, so then it will become the perfect figure. So you can take either way. There will be no error in this case. Okay, existing debts rupees 13,30,000. Okay, now external funding. Now here this time it is positive. Earlier in 2 cases it was negative. So here the 13,42,000 my figure comes here. Okay, student. Now I just go by the logic. Okay, profit after tax is 17,23,905. Okay, I pay the dividend of 8,61,953. Okay, dividend is paid. Okay, and next is asset increase. Asset is increase is the same. That is 8,74,500. Okay, so the balance will be the EFR here. So if I add up this amount, both amounts, the figure will be here. Required amount. Okay, student. So I hope now it is clear to you. I am just seeing the query, what query we have received. So I will take up. Mamta, in the assignment 1, why we have calculated 8% on total. See, Mamta, please see, we have issued the debt in the year 2017 somewhere. Okay, so it is not the complete year. Okay, if you see the assignment, 10% bonds have been in the bracket, it has been issued 2017. So they have been issued in somewhere in 2017. If they have been issued, nothing has been mentioned, 2017 has not been mentioned, then of course we shall take the interest for the complete year. But here, since it has been mentioned, so we have accordingly taken lesser amount of interest. Okay, if you refer my previous video, then you will come to know very properly. Otherwise, you can contact me over the telephone. Yes, Ginny, your answer is correct, beta. Okay. Okay, Mamta, you have sent. I have a doubt. Now I think it is clear to you. Okay, beta. Very good. Okay, student. Now I'm coming to the last question of the second last question of the assignment. That is question number 3. Okay, quickly we do it. It is one of the questions that has been come in our earlier examination. Okay, in the old scheme. So I have slightly modified it. Okay, question is that the balance sheet of the MS Sundry Limited has been given like that. Okay, these are the share capital, reserve and surplus, long-term debts, short-term loans, payable and provisions, and here the fixed assets and inventory has been given to inventory receivable. So there is a portion of current assets as well as current liabilities. Okay. Nisha Patel is saying, sir, we will get a copy of these questions. Student, this is the assignment. You can get it downloaded from your BUS knowledge portal. They are already available there. Okay, you can download it from there. Okay, still if you face any problem, I will share my email ID with you. You can get it from there. Sales for the year was 6,000 lakh. The sales are expected to be grow by 20% during the year. The profit margin and dividend payout ratio are expected to be 4% and 50% respectively. So accordingly, profit margin is there and even dividend payout ratio we have been provided. The company further desired that during the current year, sales to fixed short-term loans and payable and provision should be in the ratio of 4:3. Ratio of fixed asset to long-term should be 1.5. Debt equity ratio should not exceed 1.0. Student, here please note that this is an additional type of conditions that has been given to us. Now in the previous question there was no such condition. Only the condition riders were that this much of asset increase was there or this much of dividend has been declared. Now here they have put some additional riders, like you have to maintain some ratios. Okay, you have to maintain some ratios. Like in case of when we were calculating sustainable growth rate, we are only concentrating only one ratio, and that was leverage ratio. That equity ratio was our main concern, that it should not be get distorted. But here there are some additional conditions and we have to meet these conditions. Okay, student. Now let us see. First, we are required to determine the external funding requirement and the amount to be raised from the short-term, long-term, and equity funds. Basically, equity funds here implies equity. Okay. Of course, when we talk about the equity fund, so there are two portions. Equity fund in equity plus reserve and surplus. Generally, reserve and surplus are considered as a retained earning as well. Okay. Now let us see the solution. Okay. It is a very good question. Now, first of all, we have to compute external funding requirement. Okay, I will show the external funding requirement by both way formula as well as logic. Okay, even you can use a simple table, it will be suffice. Okay. So first of all, we take the expected sales. Okay, now here it says there is a sale for the year was 6 lakh and it will grow by 20% this year. Okay. %20 increase. Okay, now here the profit margin is our 4%. So whatever be the sales, the 4% profit profit will be the 4% of the same. Okay. Now since here it has been mentioned that the dividend payout ratio will be 50% respectively. So here I say dividend payout at the rate of 50%. Okay, beta. So here I will pay 1 lakh, 144 lakh. Okay, now out of this 288 lakhs, 144 has been declared as dividend. The balance is plowback. Okay, now it says now we have to determine how much external funding will be requirement. See here, student, our total assets is 14 lakh, 14,000 lakh. Out of this is current liabilities. So as I told you in earlier class, current liabilities are the spontaneous sources of funds. So we will assume that they will also increase in the same proportion. Okay. So accordingly, what we see, additional funds required. This is total asset. This is current liabilities. Now we are considering the 20% increase. So overall, there will be increase. Fund requirement will be 2,400. Okay, a part of this is financed by our retained earning. So remaining balance, that is EFR. Okay. Okay, student. Now it is clear to you. I hope it is clear to you now. Now I am taking it as a formula-based approach. If I consider it on a base of formula, okay. Now asset increase was 14,000 into 20%. Okay, minus current liabilities. There was a change of again 20%. Okay, minus our retained profit was 4% of 7,200. Okay, that is a modified sale, revised sale, into 50% we have paid as a dividend, or I can say write it like here that 1 minus 0.50. Okay, I am just writing here a formula, student, again for your knowledge. That is assets upon sales into this figure. Okay, and this is my liabilities upon sales into change in sales minus my profit margin revised sale into 1 minus dividend. Okay, so same logic I have or same formula I have applied here. Okay, the figure comes 2256 lakh. Okay, student. Now here our first part is clear that this much of external funding we require. Okay, now we come to the second part. Okay, now we come to the second part. So first part is our clear. Now we come to the second part. Now in the second part, it is has to be we have to see how much amount we have to raise from the short-term loan, long-term loan, and equity funds. Reason is that we have to see these conditions as well as keep in mind. Okay, we have to see these conditions as well as in this mind because this should not be distorted. This should not be distorted. Student, please note here that I have increased, very important point, I have taken the figure of 2 lakh here, although this is a part of current liabilities, short-term loan, but I have considered only spontaneous increase of 2000. Okay, normally student committed has committed mistake while they were answering this question. They have also included 3000 there because here we have to go by these conditions. We have to see. So first of all, we have to match these conditions. So that's why we have excluded this figure in our calculation. It is very important. Okay, student. Now I am coming to second part, that is funds required. Okay, first of all, I am doing it in a form of we have to do it by the equation. We can say equation form. Okay, because it says that we have to maintain the ratio of 4:3. Okay, loans, short-term loans, and payables and provisions should be in the ratio of 4:3. Okay, so let X be the new short-term loan. Okay, then meeting the additional condition, additional requirement of ratio to be maintained. The position comes as follows. Okay. This is our provisions. Okay, 2000 that will increase. That will be the new amount of loan. So accordingly, this amount is okay. It says sales to short-term loans and provisions. Okay, should be in the ratio. So sales is our 6,000. Okay, now this year our sales will become 72,000. So this will be the figure. This is the sales ratio. This is sales, and this is overall current liability. So we can say that situation we pose it here like that. Okay. Now when we solve the simultaneous equation, the figure comes 3,000. It means our new revised position of short-term loans, provisions, and accounts payable is 3,000. Okay. Sorry, not new short-term loan. Okay. Accordingly, the new short-term loan amount justified is 3,000 lakh. Next, existing amount. Okay. So additional fund to be generated from short-term loan will be nil. Okay, student. Now, similarly, I come to the second part now. Why I have to, what my second condition I have to meet. The second condition is says the provision should be in the ratio. This is for sure. The ratio of fixed assets to the long-term loan should be in the ratio of 1:5. So ratio of fixed assets to long-term loans. Now, student, here it says my ratio. So ratio I have to maintain 1.5. My existing assets is fixed asset is 6,000. Revised fixed asset is 20% increase. Okay, long-term loans. Okay, accordingly, what I do, I just solve it. So long-term loans new will become figure 4,800 lakh. Okay, student. So my new long-term loan here. Okay, less existing amount of long-term loan. So this will be fund to be generated from long-term loans. Okay, this much of funding. So we are getting the one part of our answer. That is amount to be raised from long-term loan. It has come zero. Okay, now short-term loan, sorry, zero. For long-term loan, it has become 800 lakhs. Now we have to calculate this last figure, how much we have to generate from the, or to be raised, not generate. We have to, I am just cutting it, it is to be raised. Okay. Now last, funds to be raised from equity. Here I have to see whether I have to meet any condition. Okay, it says the debt equity ratio should not exceed 1.5. Again, there is a condition. Okay, again, there is a condition, that is debt equity ratio should not exceed 1.5. First of all, I here write external funding requirement total. I have computed here. Okay, less amount to be raised from short-term loan. nil. Okay, amount to be raised from long-term loans. Okay, 800 lakh. So balance will be from equity. Okay, balance to be raised from equity. So it means 1450 lakh we have to generate from the equity. Now we have to see whether we are meeting the condition or not. Okay, now we compute the revised debt equity ratio. Okay, now I compute a debt equity ratio. So here, if I write the debt equity ratio, that is my 4,800. Okay, because I have issued 800. Okay, here 4,000 was earlier. So overall figure is 4,800. Okay, my earlier equity was 3,000. Okay, retained earning here, if I check out, my retained earning is here 144 lakh. Okay, so that is also the part of equity now. And earlier there was, well, let me show you. Reserve was 2,000 plus there is an addition of 144. Okay, so overall 2,000 existing plus revised is 144. Okay, okay, and additional equity I have to sorry, additional equity will be, so let me show you. One second. Now, overall additional equity I have to issue it from the, that is 1456. Okay, out of which 144 here. Okay, so my amount will be this. So this much of equity I have to issued. Okay, this much of equity I have to get it issued. New equity issue I have to make, because overall we have to make the addition. One second. Okay, overall addition I have to make 1456. Okay, out of which 144 is from the reserve and surplus retained earning. Okay, so balance will be from the equity. Balance will be from the equity. One second, let me check. One second. Okay. Just let me compute it here. External funding required. Sorry, student, here 225 already has been considered. This 120, my mistake here. Just consider this 144, because see, okay, just consider here 1456 only, because I have already factored in this portion. Okay, I have already factored 144 here. So please consider this amount. So ultimately, new equity to be raised from the new equity, that is 14560. Okay, now student, if we want to confirm whether, okay, now my one mistake. Now if I total this, Okay, my answer will be 7270. Okay, the answer will be 7270, and thus condition that debt equity ratio should not exceed 1.5 is met. Okay, student. So now question comes, if I want to check whether this figure is correct, okay, whether this figure is correct or not. It may, because this doubt even at this time I have raised in my mind. So what I do, I just prepare a quickly a balance sheet. Okay, post increased balance sheet, modified balance sheet. Then I will come to know whether my all calculations are correct or not. Because even this doubt has come to my mind while I was solving the question. I was thinking that I have committed mistake somewhere, but I realized that already it has been factored in. Okay, student. Now here I start putting up the figure quickly. Fixed assets, that is increased figure, 72 lakh. Okay, all other items. Inventory are increased by 20%. It becomes 6,000. Okay, receivables, 2,400. Okay, cash is 6,000. Okay, now accordingly, my share capital. Now I see here my share capital was earlier 3,000. Okay, now 3,000 plus my new capital issued 1,456. Okay, reserve and surplus. Okay, 2,000 was earlier. Okay, plus 144. Okay, long term loans 4,800. Okay, short term loan, it will be the same figure. Okay, payables and provisions has been increased. Okay, now let us match the total. So it means overall our conditions are met and we are gone through this. Okay, student, I hope with this concept of uh, clear to you, external funding requirement. And even if the in the question, if it has been asked you to prepare, uh, Anila says, sir, why short-term loan is not considered in current liabilities? Anila, your observation is correct. But since a condition has been given that you are not to increase short-term loans, for some, there are some conditions. So you cannot presume that it shall be increased in the same percentage as per the sales. Of course, it has not been mentioned, then we can assume the same, because what happens generally, it is said that generally the see if you know the credit limits or bank limits, etc. Generally, sometimes they are increased with the increase in the sale. So they can presumably, we can presume them that they are increasing, but not here. Sir, cash receivable amount to be 200. Or let me check beta. Let me check. Of course. Yes, you are right, beta. I have committed mistake. Yeah, you are right, beta. It should be, who has pointed out this mistake? Anila, very good, beta. My mistake here. This figure will be increased. 2,880, 720. Now you please tell me the total and let me confirm it. Okay, beta. Now I'm coming to the last question of this assignment. Okay, I'm coming to this question. Now, student, if you read this question, it is one of the very simple question. And why this question? Of course, a advanced version of this question will be covered when we shall take up the topic of security valuation. But here, my purpose here is to make you aware about a strategic decision. Okay, sometime what kind of a strategic decision the company has to take. Now I'm just reading out the question, or you just read in 2 minutes so that I can proceed further. Now it says DEF Limited has outstanding 10% callable bonds. Now what is callable bonds? Callable bonds, I will explain you, just have a patience. Bonds of rupees 20 crore and has 10 years to maturity. The call premium is 7% of par value of bond. Okay, call premium, the company that will pay for calling the bonds. Since for the last years, due to falling interest rate in the market, the company can issue 10-year bonds, okay, with the same feature of the same amount at interest rate of 8% per annum. The flotation cost of new issue is expected to be 60 lakh. You are required to advise. Okay, it is kind of a strategic advice whether it should refund the old bonds and issue fresh bond at a lower. Now, student, let us see what is callable bonds and portable bonds. Okay, just I take you. Just let me check whether I have covered or not. Remember, I have covered in the last class or not. Just a 2 minutes discussion will be there. Okay, I think we have not discussion. Okay, just I'm taking back to my slide. Now, refunding of bond is a kind of a strategic decision. Okay, what happens generally when the interest rates are falling, the company may be interested in refunding the old bonds and issuing the new bonds. Okay, now call feature. What is call feature? And I just give you. Just you read the slide, then I give you the example. I explain you. Call feature is not free of cost because companies are supposed to repay the higher amount of face value of the bond, which is called call premium. That is a type of strategic financial decision and capital budgeting method is used to value. So now here it is very important which method is we use. It is capital budgeting method that we have covered this here. Side is saying, sir, please show the answer part again of B and C part. Okay, beta, just have patience. I'm just showing it to you again. Now, student, see what happens when we. I just show you, but there are two type of bonds. Okay, generally there are some plain vanilla bonds. Okay, just you issue the bonds. Say a company has issued a bond of say 1,000 rupees. Okay, the maturity period is 5 years. Okay, the coupon rate means you know that the fixed rate of interest that is paid, say it is a 8%. So what happened? The company pays 80 rupees, 80 rupees, 80 rupees for the 4 year, and in the terminal year it repays you 10. So this is a simple vanilla bond. However, there is another category where there is some choice is added. Okay, this is called callable bonds. Okay, here it is puttable bonds. Callable bonds means the company has a choice to redeem the bonds before maturity. Accordingly, in this case, if the company has issued the callable bonds, okay, they can refund the bonds anytime during the maturity period. Even they can refund here, they can refund here. Okay, because they have a choice or a right, not an obligation. Okay, as per the vanilla bond, they have the obligation that they will redeem only at the end of fifth year. But now here it is they have a choice or a right with the company. Accordingly, another category is puttable bonds. In this, the investor or holder of bond has choice to surrender or lodge bond to company for maturity before its maturity its period. Accordingly, see what happens. Here the investor has a choice. Okay, he can submit his bond for any time during the year. Okay, so but what happens? This right of callable bonds is not free of cost because company is buying some kind of a choice. Okay, so they have to pay some premium when they are say going to redeem before the maturity period. So they have to compensate the investor. Similarly, when in case of puttable bonds, what happens? They are generally at a cheaper coupon rate. In this case, see, if a plain vanilla bond is trading at 8%, so it is not possible that the puttable bonds will be issued at 8% because here they will have to pay some premium. Okay, it can be in the form of say 7%. They may say, okay, we will pay you 7%. Or even in this case, it is possibility that the company may say that we may redeem your bond at some discounted price. But generally, more provisions are like that. It is generally they are issued at lesser amount of interest. Okay, student, because generally the bonds are never redeemed at a discount. So generally, so something arrangement can be made. Okay, so I hope it is clear to you. Now I am going back to the assignment. Sahil was saying, sir, part B or C is question. Just show it again. Answer again, Sahil. I think you were asking for this, beta. Part B, I could not get exactly you want to say here. There are two parts. First is external funding requirement. I think it is clear to you. Then it is okay. It is funds to be raised from this. So accordingly, students, you should have understood by now what is callable provision and what is puttable provision. Now, student, please understand. When I will talk this callable and puttable, you will uh, came to know about this term in more detail when we shall discuss the topic of derivatives. Okay, there is a terms are call option and put option. While the call options are attached with the purchasing choice or privilege, the put option are attached with the selling right. Okay. Okay, Sai. Now even you can refer my recorded video. You can play write down the answer at this moment. Okay, student. Now I'm coming to the solution part. of the question number 4. Now, as I told you, it is a it is to be considered as the capital budgeting decision. Okay. When we talk about capital budgeting decision, in a capital budgeting decisions, there is initial outlay involved. Okay. Then there is some annual or periodic cash flows are involved. Okay. Generally, NPV methods are more used. Okay. Generally, NPV methods are more used. Uh, One student is saying, sir, inputable or discount will be deducted. Generally, it will be deducted, not discount. They may say some charges, etc. Or of course discount. But I am little bit doubtful about is that whether the bonds are redeemed at discount or not, because generally that's why generally the putable bonds are issued at a lesser price, lesser coupon rate. Okay, I will come back to you in the next class if I could have carry out some research on the same. Okay, now next is initial outlay. Sorry, NPV. We have to two elements are there, annual. So what we do simple in NPV method, what we do, we compute PV of period cash flows. This is periodic cash flows minus PV of, or we can say initial outlay. Simple logic. Okay, this is becomes our NPV. So same logic we shall apply here. Only the difference is that here initial outlay will be, now here student please note in this question why is using the decision, because earlier they have issued a bond of 10% which have a period of 10 years maturity. So now the rate of interest has come down. Okay, so they are saying issuing the new bonds. Okay, so what they are doing, they are issuing the new bonds and refunding the old bonds. Okay, so and ultimately what benefit they will get? They will get a benefit of 2%. Okay, so 2% for the 10 years. So that's why they are taking a capital budgeting decision. Now, what are the initial outlay they basically they have to involve? First of all, call premium. Okay, call premium will be rupees 20 crore. Okay, just a second. Okay, then flotation cost. Okay, overall there will be 220 lakh. Now, student, you will say, sir, we are refunding the bonds. Of course, our initial outlay will be 1 second. 200 lakh. Okay. Now you will say, sir, we are refunding the bonds, so we shall. It will involve the initial outlay will involve the initial this amount. Please, student, very important to note. I am issuing the new bonds and refunding old bond with the same amount. Okay, with the same amount. Money is coming, yes, Nisha, but it is money is coming, but money is going out. So what I am doing here, I am refunding, issuing the new bonds of 20 crore and refunding old bonds of same amount 20 crore. So ultimately there will be no initial outlay involved on this part. initial outlay will involve that is on account of call provision and flotation cost only. Okay, so this will be my initial outlay of the funds involved because this premium I have to pay from my own pocket. This is plus flotation cost of new bonds. Okay, so both things I have to incorporate from my own pocket. One second. Okay, now what is my annual cash flow? Okay, this will be my annual saving. Okay, so this much of saving, annual saving of interest. Okay, so these two figures are now available with me. I simply apply the rule of NPV. Now this is will be rupees 400 lakh, that is 4 crore into present value factor 6.709. Okay, now here the question will arise. Very important point. What present value factor we have to use? Okay, what present value factor we have to use? Now, student, here you have to take a very consciously make the calculation. Here we shall, first of all, we have been given the present value factor table. Now, student, please remember, it is very important point to remember in the examination, if you have been given table like this, so you have to consider PV factor to 3 decimal point only. Okay, neither 2 nor 4, because here you have been provided this. So here two important point. First of all, the new discounting factor will be, even this table has not been given, because this table has not been given to you. So you will discount the same cash flows at the new rate of new bond rate. Okay, so you will use this 8%. Okay, accordingly the total comes 6.709. In examination, if nothing table has been given, so my request to you, you should use the PV factor up to 3 decimal point. Okay, if nothing has been mentioned. Of course, if you are using up to 4 decimal point, the answer will not be get incorrect. Okay, you will get the full marks for the same. If there is no PV factor table has been given, so we normally consider, we not normally, we compulsorily consider that there should be rounding of difference should be ignored. Okay. Yes, Nisha Patel, it is net off, but net off will be 0. Okay, student. Now initial outlay. So our NPV is 68 lakh 36,000. Yes, we should thus NPV is positive. We should refund the bond. and issue new bonds. Old bonds we can write here. Okay, student. So please again, concept of portable bonds I am missed due to network issue. See, better portable bonds means the investor has the right to get the bonds matured before its due period of maturity. In case of callable, the right lies with the company that they can redeem the bond anytime before the maturity. But in case of a putable bonds, the right lies with the investor that they can submit or they can surrender or they can lodge the bonds before the due date of its maturity. Okay. Generally, they when they will do, of course, if the interest rate are falling, then company will write their right of callable bonds. Okay, those. And if interest rate is increasing, suppose you have purchased 10 years before 8% bond. Okay, after 3 years, the rates has come to increase to 10%. So you will like to redeem your old bonds and purchase your new bonds at 10%. But you should have a right of, you should have a puttable bonds. Okay, that you have a right of putting your bonds. Okay, student. Okay, student. With this, we come to the end of this session of the first class. Now, I am just quickly starting this uh, next topic, risk management. Okay, of course, the assignment is there. Now, risk management topic, student, please, as I told you earlier, this topic is basically is not dealt in a detail here, but because the purpose is that here it is concentrated on the financial risk. Okay, our purpose is, but of course we have given some list here of the risk, but this is not exhaustive list. It is only restrictive list as there can be an n number of bonds, n number of risks, not bonds. Now here our learning objective is the identification of type of risk faced by the organization. Mainly we are concerned with the evaluation of financial risk. And there is a concept of VaR. Generally, VaR concept is very important, and today we shall cover their numerical questions. Then this is the theoretical part, evaluation of appropriate method for the identification and management of financial risk. Now, student, first risk, very important risk is strategy risk. Now, simply if I say here, 1 second. If I read the definition, it is the risk in which company strategy becomes less effective and it struggles to achieve its goal. It could due to the technical changes and a new competitor entering the market, shift in the customer demand, increase in cost of raw material, or any number of other large scale changes. Now, student, of course, what is strategic risk? Student, basically what happens is strategy determines what it determines what, okay, how and why. Basically, if I say the strategy is the foundation of any company, okay, if it is goes the wrong, okay, so then everything falls. Now, what we say that we should not may accept the changes. Okay, if we say that we sit only and calmly say whatever business I am doing, I will continue with the same. It is also a risk. Okay, because with the changing of time, you have to update yourself. Okay, now if I say that in our time when we were doing the CA, there were no ITT classes were there, no GMCS classes were there, and we have to struggle out at our own. But with the passage of time, when the institute have realized that these are a very prime important thing requirements, prerequisite for a new chartered accountant, So they have introduced the course. Okay. Similarly, we have to update ourselves for the new developments. Otherwise, if we continue our old syllabus, then nobody will like to join the course. So we have to keep updated. Similarly, so that's why it is very important that uh, it is without any guarantee of success. It becomes risky to either do something or omission of action or choosing nothing to do. So means that it becomes risky. So there is no guarantee of success. It is a risky to choose something or not to do something. So strategic risk is this type of a risk. You have to see that because there are many examples. If I start giving you the example, there are n number of examples. Like one of the very prime example is given is like of Kodak. Okay, somewhere around in 2007, when digital camera revolution has come into the picture, or nowadays the mobiles are there, you can take the n number, the numberless pics are there. But earlier there was a time when Kodak was a company, you used to have a film roll there, concept there. Of course, they have invented the digital picture camera, but they could not sustain it. Okay, that's why other companies like Canon, Sony, they have taken advantage, and ultimately situation has come. The Kodak has become bankrupt. Okay, the Kodak has become bankrupt company because they could not continue with similarly like Nokia. Okay, they could not come out with a smartphone at right time. Okay, they were maybe thinking that we have a monopoly in the market, so we are. Sir, can you? Student, is my voice is breaking? Just to tell me so that I can. Uh, Let me. अशोक जी, आवाज में कोई इशू आ रहा है? अच्छा अच्छा, ठीक है, ओके ओके. Now next is Nokia. Nokia companies, they were considering that we are a monopoly, so we will. But ultimately, they have out the market. Similarly, what happens sometimes we have to adopt the destruction strategy, self-destruction strategy, like Netflix. Very good example. Now today, if I talk about your Netflix, it is one of the OTT platform. Now, but there was a time when Netflix company was involved in physical delivery of the DVD on rent. Okay, what they used to do, they have a company, and if you send your request, they will send you the DVD. You will watch the DVD. They will collect it back. So there was a, but with the coming of the internet revolution, they have started realizing that the business will not be sustainable anymore. So what they do, they start destructing their own business. They have start stopping their business. They have start switching over to the OTT platform because it was a future. So accordingly, what happens? The share of a Netflix, which was going down in 2010, somewhere around in 2015, the CEO of this company has been awarded as the best CEO because they have realized the importance of the future. Because see, strategic means you have to combat the challenges. So even doing nothing is very proved to be very costly one. So similarly, Amazon. Another example is Amazon. Amazon has started Kindle, realizing that the concept of e-books will become there. So they have start Kindle. Think even it was leading to loss of their business of selling the books or hard copies of the books. So all these are examples that you have to do something. You cannot sit silently. Even what happens, there are some decisions like merger acquisition, you can say diversitudes. That is demerger. Even merger acquisition decisions are very important. Okay, sometimes you take a wrong decisions, it proves you very costly. Okay, even demerger, sometimes you divide the companies. Okay, but you later realize that I have lost a very profitable part. Okay, there was some example like the Ford company has divested their business. Okay, but they have got the benefit of because they have concentrated more on their core business. But sometimes it may lead to that they may have lost a very profitable company. So all these are examples of strategic risk. Okay, now all these are examples of course, they carry the risk. Sometimes this can risk be in the any consumer taste. So n numbers of risk are there. So this is called strategic risk. So now next we comes to the compliance risk. Now compliance risk is basically deals with the uh, complying of the laws. What happens? There are a plethora of the laws, okay, which every company has to comply with. Like here we have a Companies Act, even we have a SEBI regulation. So all these you have to comply with. So in case if you don't comply, then certainly you are carrying the risk. I just give you a very small example. If I am a chartered accountant, I am a member. Okay, I have to pay my fees by some particular date. Okay, if I don't pay my fees, of course, I will have to pay the fine. So this kind of risk is there. Similarly, it is a risk in the business. So business, we have to comply with the various formalities, even like Provident Fund, ESI. There are many things. So we have to comply with all the formalities. Otherwise, we are faced with the risk. Now, next comes the type of risk, operational risk. Now, this is very important and very interesting type of risk. Now, when we talk about the operational risk, generally it is concerned with, if I say it is day-to-day operation and related to people as well as process. Now, how it is people? Generally, it is people means it is relating to like related to frauds. Okay, now recently there was I think it was a Microsoft issue, technical glitch was there that screens were blackout. Okay, there were even the some flights in USA and Australia have to be cancelled out because of this technical glitch. Recently, just I think it maybe 1 month or 2 months back. Now, I think it came to my knowledge that this was due to some error by mistake committed by one of the person. So this type of a risk generally are created by any pupil or process. Sometimes our process can go wrong. Technical glitch process can also be gone. And when we talk about the process pupil risk, operation risk, as I told you, there was one very famous case of barring bank. In this case, as I told you, the person Nick Leeson was the person behind that who took the very huge position in derivative market and ultimately led to losses in the collapse of this bank. So ultimately, this is considered to be one of very prime example for the operational risk. Now, operational risk is another very important. Now, it is very important. Operational risk is cyber risk. Nowadays, this is one of the very prime risks. If I talk about the various categories of the risk, generally a ranking is created, ranking is made for the various type of operation risk. So on this, nowadays the cyber risk is very important. Cyber hacking, like there is one recently there was one example of AIMS hacking at the AIMS. Delhi AIMS, there was a cyber attack, and ultimately there were a lot of effort has to make the recover the huge loss of huge amount of data. So all these are kind of a operational risk. Now another is kind of a financial risk. Now when I talk about the financial risk, see financial risk ultimately see whatever be the risk is there, ultimately it will lead to financial losses. There is no, we cannot say deny the fact because the object organization means money. So whatever be the risk to the organization, it is a risk of financial losses generally. Now, what happens, student, when we talk about the financial risk, generally these risks are related to like prices, exchange rates, credit rating, and interest rate, etc. So generally prices are means of generally commodities prices are there. Okay, the company is manufactured like petrol company. Okay, so if they are, of course, in a petrol company, they have advantage that normally whatever with the increase in the petrol, they charge it from the customer. But sometimes if the condition is liable that you cannot charge a certain more than certain amount, then certainly the increase in commodity price will be problem for them. Exchange rate, as I told you, given the example that in the earlier class, if you are exporting the goods, today the rate is 84 or it, and by the time amount comes, okay, rate come down to 81. So the 3 lakh loss will be there if you are an exporter. Similarly, if you are an importer, the same risk is there. Credit rating generally attached with the company's credit rating. Company may have a credit rating for their bonds. So if it goes down, of course, the sale of their bonds come down, or the popularity of their, they start feeling problem in generating the funds, and again, and they have to issue the bonds or new make the new issues at a higher price. Then interest rate. I have given you how the interest rate affects the banks. Okay, and generally this interest rate is more uh, dominant in case of a bank. Why it is dominant in case of a bank? Just I give you a very small example. Suppose if a person have made have got made an FD at 8% and issued and made of 1 crore rupee. Okay, now what the bank has done? This 1 crore has been passed to another lender borrower at 12%, or we can say it is a 10%. So ultimately, bank is earning 2%. Now what happens? Tomorrow, after 1 year, the rate increase in the market. Okay. Now this person has made the FD for 5 years. Accordingly, bank has given the loan for the 5 year. Now suppose tomorrow, if the rate of interest goes up in the market at 9% after 2 years, now interest of this customer will be that I get redeem this 8% FD and get issued no 9%. Of course, there will be some penalty, etc. He will not, he will say, not, I'm not bothering about the same. So what will happen? Bank will face the problem. Bank will face the problem. Okay. Because this customer will come here, he will ask for the say, I want 1 crore rupee my back. Now this customer will not refund the money. Okay, so this kind of an interest rate. Even bank may have a problem. This is generally called basis risk. This is called, in a part of interest rate, this is called basis risk. So there are some very, this is called financial risk. Okay, even sometimes, though political risks are not directly connected, not financial risk in a direct sense, but generally unexpected, that we will discuss what is the political risk. Any action by the foreign government results in the financial risk. Now, student, I think we can take a short break here. I will continue my discussion after a small break. Then we shall solve the questions of assignment. Okay, student, I'm just going for a small break here. Ashok ji, Ashok ji, break start. Okay. Okay, student. Now next risk we are coming is a counterparty risk. Basically, this risk is take place due to the default by the counterparty that makes to fulfill its commitment towards any interest or the loan. Generally, this is case of a banks also very prominent, where the investor lender borrowers take the money and does not return to the bank. So generally, it is also called the credit risk. It is also called the credit risk, and because this is default by the counterparty. Generally, this is a part of financial risk, but these are mainly prominent in case of a even like uh, uh, customer who have purchased the goods on credit, but they are not returning. It is that can also comes into the category. Now there is another category of the political risk. Generally, this type of a risk is faced by an overseas investor as the adverse action by the government of the host country may lead to the huge losses. Students, sometimes what happens, it is another, it is a very good example of the same is, I want to discuss with you. There was a one case of GMR, a company which is involved in the in setting up the infrastructure for the airports. Okay, I think somewhere around in 2012. Okay, so the government of let me check. I have noted it down. Yeah, in 2012, the GMR have lost a contract of about $511 million at that time in 2012 because what happened? The just 1 year before that is in 2011, the government of Maldives has been changed. Okay, so Maldives government has changed. So accordingly, what happens? Their government, new government, changed, cancelled the contract that has been earlier entered by the previous government. So by this, hence we can say that ultimately it is the decision by the previous government, but reversed by the new government. It's kind of a risk called the political risk. So even like sometimes even political risk sometimes may also be caused due to some political turmoil. Like in recently in a newspaper there was a mention that some Indian exporters are facing a risk due to political turmoil in the Bangladesh. So all these are kind of a political risk. Now next is a category of interest rate risk. Okay, that I have told you. As in earlier class, I have given you the example. If bond have been issued at 8% of the 1,000, now tomorrow interest rate rising at 10%. So the maximum price I will pay for the same bond will be 800 rupees. So this loss of 200 is also in the category of the interest rate risk. So this is a kind of a there is a currency exchange risk that I've told you. There is no, I'm not repeating here because there is a full-fledged chapter. See, student, for currency risk, for interest rate risk, there are full-fledged chapters. Okay, of course, for the stock market risk, there is a topic of portfolio management. So all this risk will be covered in there. Broadly, liquidity risk is means the inability of a firm to meet its obligation. Now, student, in this regard, if you recall that in your topic of working capital management, in case, especially in case of a cash management, cash budgets are normally prepared. Okay, why we prepare this cash budget? The answer is this liquidity risk, to avoid the liquidity risk. Because you prepare in advance the budget, that is, you will say, okay, this much of amount will be of sales, this much amount will be of my expenses, this will be my profit, this will be my dividend, and ultimately this will funds. I have a balance in the beginning that will be at the end. So ultimately, you came to know where there will be a deficit or where there will be a surplus. Of course, surplus is not a problem that much, but deficit is that much a problem because if you don't fail to meet your commitment on time, then it will be a problem for very big problem, especially in case of a bank. If you have heard the term of bank rush, now what is bank rush? Bank rush means all depositors are moving to the bank to get back their money. Okay, if they are going back, because see what happens. Ultimately, if you have some idea of cash reserve ratio, a bank normally does not keep all the deposits in the cash anytime. They normally lend it in the market. Okay, now some cash they are kept for meeting the cash requirement of the customer. Now, if all the customers turned up there, of course, bank will be collapse. So that is very important. So liquidity risk, of course, we cannot keep all the deposit in cash, but we have to see that if we should not be in a situation that even a simple cash requirement could not be met out. So this is all are covered in the liquidity risk. Then evaluation of financial risk from stakeholders' point of view. Generally, how we view this risk, generally from stakeholders' point of view, as I told you, ratio of debt in the capital structure, that is financial leverage. Okay, if the company increase the debt, okay, if the company increase the debt, then it becomes a matter of worry for the shareholders because they normally view as a financial risk. They consider it as a financial risk. Okay, now similarly, if the company in the winding up case, they will get debt will be first cleared up, then the shareholders will come. Then another is from company's point of view. Now, when company's point of view, when company see borrows excessively or lend to someone who defaults, then it can go into the force into the liquidation. Now, over borrowing is also risky. Okay, that is financial leverage. And even you are lending, say bank is lending to someone who will default, then it is also risky because the margin is very less. And if someone takes the money, then it is always a very big loss to the banks. Okay, so similarly, so that's why even for the goods, you are selling the goods to some customer who have become bankrupt or who are not unable to pay, who is unable to pay. So in that case, you have to see that you have to keep the risk in your limits. That's why it is called risk appetite. There are many models for the frameworks for the same. Now, next is the from government point of view. How the government view the risk. Risk can be viewed as a failure for any bank like Lehman Brothers crisis. Okay, now here student, what happens? Lehman Brothers crisis is also example of the strategic risk as well. Now, what strategic risk was there? Generally, banks have invested in the mortgages without any backing. Okay, so it was also a strategic decision wrong. Okay, if I talk about 2008 crisis, it is an also example of a strategic risk. Why? Because banks have invested money in the mortgages. Mortgages means the loans that has been taken by the borrower for buying the houses. But these buyer don't have any credit standing. Okay, there was just only a saying that okay, we will get this of money. So there, because norms have been relaxed. Now today, if we go to the taking the loan from the bank, there are many formalities we need to comply, and even bank confirms about or make a due diligence about the credit worthiness of the customer. But around 2008, before 2008, what was happening for around 2 to 3 years? US and UK banks have liberalized this mortgage loan. Okay, and when they have liberalized the norms, even a pauper or even a you can say very lower persons with a very lower credit history are taking the loans for the bank. Okay, yeah, subprime crisis. Nisha, you are right, beta. So what was happened? Ultimately, they have invested the money. Bank have invested the money in these mortgages. They are financing these mortgages. So this is also a strategic risk. Also, it is an example of strategic risk as well. Now, from government point of view, what happened? This bank, Lehman Brothers Bank, have failed. Now, bank is a backbone of an economy. If any bank is failure, it is a very great risk to the government. So even government tries to save this kind of a situation so that ultimately it may not lead to collapse in the economy. So, and even it spreads the distrust among the society law. So, and even sometimes it leads to sovereign debt crisis. I give you a sovereign debt crisis example somewhere around in 2008-9. The Greece government has defaulted on its bonds. Now, today, if I talk about the government of India bonds, they are saying they are risk free. Why? Because there are surety that they will be refunded. But somewhere around in 2002 and 2008-9, the Greece government has defaulted in the refunding of the bonds, and that is one of the prime example of the sovereign debt crisis. Okay, so this is also a risk for the government that they could not repay their debt. Now, student, with this, I'm just giving you the one MCQ. Okay, you are requested to I'm just giving you the MCQ. You just give me the correct answer so that I will move to the next portion. Just see the MCQ and answer the question. After that, I will take the concept of VaR, that is value at risk. And before this, it is a kind of a very good, beta. Nisha, very good. Mamta, very good. Some student has named Lenovo. So student, my request to you, please write your name so that I can take your name here. Abrikesh, thank you, sir. Okay, Tushar, thank you. Abrikesh, sir, your answer to some extent, I can say uh, technological risk, but generally technological risk is created because of change in the technology. It is more oriented towards a change in the technology. Yes, sir. Now it's fine. Okay, students. Now, correct answer is basically strategic risk. Why? Because without any guarantee, it becomes too risky to either to do something or by omission of action choose to do nothing. Okay, so we have to see that we have to take some action. Okay, if we sitting silently, then it is going to be low. Now, I am coming to the next important topic, that is where what exactly the where is. See, this concept has come into the earlier. The concept has been earlier invented somewhere around in 1920, beginning of the 20th century, but it popularly has been used in somewhere around in 1990s when we have then it is we have to see how much we lose on our trading portfolio by tomorrow's close. It is when a statement has been given. So this position it happens. What happens? Say I tell you, if I am sitting on I have some position in the market. Now, of course, I have some capacity or I have some measurement in my mind that my portfolio, at least value of my portfolio will not goes below this limit. Okay. And this level of my confidence is called level of confidence. Okay. So I say that I have a 95% confidence. Okay. The value of my portfolio will not go below say particular amount. So this is called value at risk because I know that I'm with 95% confidence. So that's why here I say my value, even I say other way around. I'm sure that there is a 5% probability. The reverse, the flip side of this 90% confidence is the probability. So I can say that, say if I am holding a portfolio of 100, okay, and where value is say about 92, okay, so I can say that I am with a 95% confidence. I'm sure that my value is not going below 92 in any case. I am having a risk. I'm 95% confident. Similarly, on the flip side, I say that there is a 5% probability that my loss will be not more than 8. Okay, my loss will be not more than rupee 8. So this is the flip side of the, or we can say other side of the, not mirror, flip side is the mirror side of the this VaR. Okay, student. So if I talk about the Wikipedia, where is the measure of the risk of investment given the normal market condition? Now, very important. This normal word has to be kept in mind. It is not abnormal. That's why sometimes it is said that where is only a measure of risk, it is not the measurement management of the risk. Okay, because we are assuming only normal conditions. Now, like if I say what are the normal conditions that's going on, but if I say in the COVID, the VaR has failed. Okay, because this is a kind of a COVID or a kind of events. This is called black swan events. Okay, black swan events means they are generally occurs very occasionally, but rarely occurs. So it says where is the measure of investment given the normal market? It is in a set period. This period is factor is very important. Okay, it can be varied. Say one day, it estimates how much investment might lose. This investment can be portfolio, capital investment, or foreign exchange. Anything it can be there. Okay. So what are the basics? What is the worst case scenario? And what was his loss? Okay. So as I told you, so it was first applied in New York in 1922, but more widely used in 1990s. Now, what are the features? Okay, now what are the features? First of all, time period is very important. Okay, my loss can be in a one day, okay, in a week, that is 5 business days. Okay, when we talk about a time, generally what happens? We generally consider one day, okay, 1 week. So in 1 week, normally we don't take 7 days. Please remember, we never take 7 days. Generally, we take the 5 days as a trading days. Okay, so it can be a 1 year. If I say it is 1 year, then it is 250 days. Okay, so generally what happens for 1 week it is this. If I say for how many weeks, the weeks will be 50 weeks in a year. Like that, we generally carry out this way. Okay, student. So this it is a time period normally we use in the VaR calculation. Confidence level generally 1990 or even sometime 90% also we use, but normally this is our common confidence level. Loss of in percentage or in amount. This can be a percentage amount of a portfolio. If I multiply this percentage amount, percentage number with the amount of the portfolio, it comes into the amount. So accordingly, student, I'm just throwing a question to you, MCQ. Now, when I just explain you, when we take these days, okay, there is one formula. Okay, how we adjust these days, I'm just showing to you, then you can compute the answer. Okay, say if I say my daily VaR, okay, my daily VaR that is a 5 lakh, okay, at 99% level. Okay, this is my daily VaR, that is one day. Okay, I want to know how much VaR will be for the 5 days, that is 1 week. So what I do 5,000, 5 lakh into square root of 5. Okay, the amount comes 11 lakh 18,034. Okay, now my VaR, daily VaR is changed in a weekly VaR to this amount. Okay, so normally whenever we have to take the time, we have to change the time, we can do that way. Okay, so this normally we similarly, if I say my VaR for a week is rupees 11 lakh 18,034. My daily VaR will be, okay, my daily VaR will be this much. Okay. So my answer will be, so both way we can compute it. Okay. So now student, on that basis, I am just uh, throwing a one MCQ for you. You just give me the answer. Very good. Nisha, very good, beta. Mamta, very good, beta. Okay, beta. Now I think most of the student has given the correct answer. Yes, Abrikesh sir. Thank you. So here simply I'm saying one day horizon, for one day horizon, the VaR is this. Okay. So this is a daily. I want to get it converted into my for the 10 days horizon. So I just apply this. Okay. The answer comes. Okay, student. So the correct option is C. Okay, there is another MCQ for you. It is, I'm just making a correction. It is better annual. Okay, it says the annual VaR of the portfolio is rupees 90. The daily VaR of the same portfolio shall be approximately. Very good, Anita. Let me check. I have to again check. Now here we have to assume 250 days in a year. So accordingly, I am just solving here. Yes, Anita, you are right, beta. Application, thank you. And Ginny, very good, beta. Anila, very good, beta. Okay, students. So very simple. Okay, the answer will be somewhere around 25 this. Okay, student. Now I am coming to similar type of a question. This is annual, just consider this as annual. My mistake. हाँ अशोक, दोबारा नहीं, मैंने उस पर लिया था, एक बार चला गया था इंटरनेट। ओके, मैं दोबारा उस पर आ जाता हूँ। अशोक जी ओके है अभी? हाँ कंटिन्यू। ओके। हाँ शेयर कर रहा हूँ स्क्रीन, आई एम जस्ट शेयरिंग, स्क्रीन शेयरिंग। अशोक जी क्लियर है आवाज? ओके। Okay, students, sorry, there was some operational risk. Okay, there is an example of operational risk. Okay, this was a failure due to electricity. Okay, now student, here what I is, it is basically the, we have to see the annual where is this. Okay, we have to compute the weekly where. Okay, now again I am expecting the answer from you. Yes, sir, you are right, sir. Abhishek, sir, very good, right, sir. Uh, So here, student, please remember there are 50 week. Jeannie Oja, yes, very good, beta. So student, here my value is basically 19 lakh 76,424. Okay, here I will divide this figure like this. Okay, so correct answer will be this option. Now I am coming to this last MCQ. Okay, then okay, the semi-annual value of the same portfolio. I am saying semi-annual. So in a annual or in a year, there are 20, two semi-annual. I am just giving you the hint. Student, I just solved your problem. Here, my annual, where is accordingly, what I will do this. Okay, now it is easy for you. So the correct answer will be 14 lakh 1,700. Okay, student. So with this, we have come. You have gone through with the concept of how the time. Now, what are the feature? It is a type of a statistical tool, and it is based on standard deviation. Now, what is standard deviation? I need not to tell, because you know that mean deviation is a standard deviation. That is how much each value is deviating from the mean. Okay, so it will be the measure that will be used. Okay, next feature is time horizon that we have computed discussed earlier. And next is probability, assuming that it is normally distributed. Okay, values are normal. What is now normally distributed indicates? Basically, it indicates all the probabilities, all the respect. This is, I need not to explain. I think you must have done at your 12th class level or somewhere where the probability, where the values are normally distributed. That is a bell-shaped curve. Okay, here in the in between it, this is mean value. This is mean value. Okay, so this is a normally distributed curve, and that will be used. And please remember, this curve will also use in the when we shall discuss the topic of derivatives. Okay. Now this can be, what are the features? This can be used as a setting of the control limit, that is maximum. My value should not be go below this. Okay, or it can be though, but these are the features of the same, and you can refer it from the Z score. Now this value will be used. Okay, this value will be used. Z score is normally standard called normal standard variable. Variable. Now here it says how many standard deviation is away from the value of a mean value of a population. So I just take back to you this diagram. Now here what happens? See, if I have to see if my value is lying at somewhere here. Okay, so what I do, I compute this Z score for this value. That is how much standard deviation away from this value from the mean, and this value I will use in the table. Okay, how we will use a table, that I will show you by way of questions of our assignment. Okay, for the time sake, you just understand that how we shall we have to use this Z score. Okay, but when it is multiplied with the standard deviation, it provides with the VaR. Okay, first of all, we compute how much it is varying from the mean. When we multiply it with the standard deviation, so we get the value of VaR. So it is the basis of VaR. So we can say that Z score into standard deviation is equal to VaR. Okay, student. Now, application of VaR to measure the maximum possible loss on a portfolio or a trading position. It is very important. Trading position means we are trading. Very important, student. I tell you what happens. Sometimes we may have a less cash, but we are trading on a higher amount. Okay, so because we know that we can meet the loss of this amount by trading on a higher amount. So this is, that's why it is sometimes we said that trading position may be higher than your cash holding. A benchmark of the performance measure of any operation or trading. Okay, the fix the limit of individual dealing in the front office. What is front office? Generally, what happens in a banks, there are three office. One is front office, mid office, and back office. Front office carries out the tradings. Okay. Second, mid office generally take care that they are in the within the limits and all the their compliances have been made. Then a back office carries out their accounting and settlements. Okay, so these are three categories of the office. So front office means though that carry out the trading, and where is very important for them because they have to maintain these limits. To enable the management to decide the trading strategies, they have to decide on trading, and it is a tool of asset and liability management. especially in the bank. Generally, it is in a bank more used. Okay, even I was student, there is a one, I think, movie, Margin Call. I think it is on Netflix or somewhere in Prime. I was here. The concept of where is also used. Okay. One second. Okay, student. Now I am. These are some theoretical portion. Student, before I will discuss, you can refer this from the study material. Okay, so that I can move to the assignment. Okay, if the time will permit, I will discuss it. Otherwise, you can refer it. So now I am student coming back to the assignment. Let us start solving the questions of the where. One second. Okay, the first question is, just you read out the question. It is a very simple question, and this question is from your previous old scheme examination. And I will say when the previous old scheme was launched in July 2017, and the first attempt took place in May 2018. So this was the first, and the concept of risk management was in the old scheme also. So at that time, this was the first question that has been asked in the examination. Now, student, if you see your assignment, there are two pages. On the first page, there are questions, and on the turnover page, that is you turn over, there is a cumulative area under normal curve. Okay, that I will discuss in the class. Okay, student, the question says like that. Neil holds rupees 10 crore share of XYZ Limited. Okay, market price or the standard market price standard deviation is 2% per day. It is very important. In a question of where you have to take care of the time period, very important. Assuming 252 days, trading days in a year, determine the maximum loss level over a period of 1 trading day and 10 trading day with a 99% confidence. Assuming that the share price are normally for a level of 99%, the equivalent jet score from the normal cumulative area is 2.33. Now, student, if I go to the table, just I am going back to the table. Here you see, student, it is the area of 99%. How we have computed 2.33? If you see here, here it is starting, and here it is 3 values there. Correspondingly, I am taking this line. So at this point, somewhere I can locate this value, approximate. Okay, so it is covering the out of 1. See what happens, I tell you. Overall, the area under normal curve is considered to be 1. Okay, area under this curve is 1. Okay, out of this, the cumulative area somewhere is right here. So this is covering our 99% approximate. Okay, and corresponding jet score. Okay, the jet score is 2.33. So it means somewhere it is here, the jet score is 2.33. How much it is deviating from this? So mean that's why we have. So now it says that I am holding a portfolio of 10 crore and market standard deviation is 2% per day, assuming that the 252 trading day determine the maximum loss over a period of 1 trading day, 10 trading day, and with the 99% confidence. So first of all, for the 99% confidence level, the jet score is correspondingly 2.33. Okay, now what I do, I compute first of all, as I told you, VaR is equal to standard deviation into Z score. Okay, now I have to compute this value in the amount. Why? Because here it has been given in the form of percentage. Okay, so what I see, what I do, I multiply 2% of rupees 10 crore is equal to rupees 20 lakhs. So this is my standard deviation. Okay, now maximum loss. Now this is standard deviation for 1 day. Okay, so maximum loss for 1 day at 99% confidence level is rupees 20 lakh into 2.33. Okay, so amount comes 46 lakh 40. This is okay. Now, if I say I want to compute this figure for 10 days, so of course, student, you won't face any problem. This figure is 46 lakh with me, that is on daily basis. As I told you, we shall take 10 trading days. Okay, and I multiply this with this amount. So my answer will be 147.36 lakh. Why we choose 0.3, sir, 0.3 beta? Yeah, yeah. Okay, column C beta, I just tell you. Your C beta, I have chosen this value. I just tell you. See here, the starting with this 2.3. This is 2.3. I need to compute 2.33. Okay, so basically this value is 2.3 is 2.30. Okay, in this I may have to add 0.233, only then I will get this value. Okay, so I am adding, this is 2.30. Okay, generally it is not used zero. Generally it is considered as a addition, or you can say it is a kind of a suffixing. Okay, so that's why I have considered here 3. Okay, 2.3. Here it is simply 2.3. See, if I have to find the value of 2.30, so I will go for this value simply. Okay, I will go for this. So not my mistake. I will go for this value. If I have to find out the value of 2. This is 2. Okay, so if I have to get the value of 2.30, so this will be the value. Okay, but I want to know the value of this. Okay, Jeannie, I think I have to check the answer, beta. Yes, you are right, beta. Jeannie, beta, you just check. I think this term. Yeah, you are okay. Okay, Nisha, I think your doubt is clear, beta. So, okay, the answer is 147. Yeah. So I hope, student, with this, the concept is clear to you. Now I am coming to the question number 2. Now this question says like that. ABC Limited is considering a project X which is normally distributed. So it clearly indicates that it is normally distributed. Normally distributed means it is like this, and has a mean return of 2 crore. So it is we can say it is a mean value 2 crore return. Okay, with a standard deviation of 1.6 crore. So we have the value of standard deviation, we have the value of mean. In case ABC Limited lose on any project more than 1 crore rupees, there will be a financial difficulty. Okay, so it means if the company lose more than 1 crore rupees, so there will be a financial difficulty. Determine the probability that there will be the financial difficulty. So of course, student, now let us see how we compute the, just for rough purpose, for our own understanding purpose, I just draw a normal curve. Okay, so the mean value is basically 2 crore rupees. Okay, now it says if the project loses more than 1 crore, so it means the value will be somewhere lying here, minus 1 crore rupees. Okay, minus 1 crore rupees. So this value will be lying somewhere here. Okay, so I want to know the probability that there will be a financial difficulty. There will be a financial difficulty that there I want to know this. So what I will do, I will find this probability. I will find this area under normal curve this much. Okay, and I will reduce it from the 1. Okay, but because this is the red portion. Okay, so what I will do, no financial difficulty. Okay, here it is financial difficulty. Okay, so what I will do, I will find the value of this much portion, and I will deduct it from the 1. Okay, now let us, I have to calculate how. First of all, I will calculate the standard normal variate. Okay, so first of all, I calculate Z score. Okay, minus 1 crore. Okay, okay. Yes, yes, Jeannie, I got it your point, beta. Don't worry. Okay, minus upon standard deviation. Okay, I am writing the formula here so that you can here x minus mu mean this formula I want to place here. I forgot. So accordingly, I find the value of variable. The variable value comes minus 1.875. Of course, the value is negative, no problem, but it means I have to find the value. It is not a negative value. We can say that we can find the value of 1.875. From this, if I deduct it from the 1, then I will get the value. Okay, so I'm not here deducting it 1, but I'm getting. So what I do, I have to find the value of 1.875. So I just go back to the table. So student, please see here. Here this value is 1.80. Okay, so I have to find the value of 1.870. This value will be 1.87 and this value will be 1.88. I have to find out the value in between, that is 1.875. So now my problem is this, either I should take this value or this value. So of course I can take it, but more appropriately it will be we can use even the interpolation method for this computing the exact value. Now how we will use it, just I show you. I consider two values, this value and this value. Okay, so I am just showing you. I am considering these two values. After that, I show it to you. How the interpolation works? Okay, how the interpolation works? I show you here. Okay, so I write Z score. Beta, here it is 1.87. The corresponding area under normal curve. Zero 0.9693. Okay, for area under 1.88, it is 0.9699. So the difference is 0.01. Okay, here the difference is 0.00006. So for corresponding 0.1 difference, the area is 1.6. So what I do, I need, see how much I need difference. My figure is 1.875. So what I do, 1.8750 minus 1.87. Area is with me available, no problem. So I need the area under point this. Okay, I need the area this. So what I do, for Z score area will be, here it is 0.1. So 0.1, sorry, I'll just do it again. I do like this. 0.006 divided by 0.01. Okay, into, I multiply this figure. Okay, so this area will be, I got 4.05. Okay, I add up this area into, well, this area under normal curve and this area under normal curve is this. So I can show you by way of this. I add up this value here. Okay, so value, Z score value 1.875 is equal to 0.9693 plus 0.003. Okay, so area comes 0.9696. So this area comes 0.9696. Okay, I have to find this area. So what I do, I deduct it from it. Thus, probability of financial difficulty will be 1 minus 0.09696, that is 0.0, sorry. Okay, that is 3.04%. Okay, why we are reducing 1.7? Can we take the average? We get the same answer, but I have to check. I have not checked it very. Okay, Anila, I have to check, but I have not checked it. Okay, I think it may work well or may not work well, but I have to check it. Okay, if you have got the same, but try it on other way around. Because here the reason is that average is working because I need this variable 5. Okay, and difference was 0, 1. So it is a half of the same. So that's why it is functioning well. But if you have to get the compute the value of say 0.007, then average will not work out. Okay, then average will not work out. Okay, please. Why reducing? Okay, okay, beta. Anila, why we are reducing? Sorry, Nisha, you are saying why we are reducing 1.87? No, beta, we are not reducing 1.87. We are adding the same. See, for 1.87, the area under normal curve, that is this much. Okay, we are adding this value. So we are not reducing, we are increasing. Okay, we are increasing. Okay, students. So here we have got the answer. Nisha, if you still have any doubt to arrive at figure, yeah, you can say I am just making the difference. Interpolation means better we find out the figure. So we are not reducing it, we are deducting it. From the 1.88, I am deducting the 1.87 value to arrive at 0. Yes, you are right. Your observation is correct. Okay, beta. Now I am coming to the last question of this uh, second session, second lecture. So student, this question has been adopted from, okay, Nisha beta, see, it is not clear to you. I am just, see beta, what happens? I'm just going back to again. This was the corresponding area under normal curve 1.87. This was area under normal curve was 1.88. So what we are doing, we are getting the difference of 0.01. Here the corresponding difference in the area for 0.01 Z score, the corresponding difference in the area is 0006, and we have to find the value of 0.005 Z score. So that's why what we are doing, we correspondingly getting this value. Okay, here for 0 point, the corresponding Z score. See, I say like that, if 0.0 Z score, the area is 0.06. If it is 1, 0.0000 divided by 0.01. And if I require it to 0.50, so what I do, I multiply this value here. Okay. Meaning the amount comes, but see, amount is not there, it is the area. Okay, it is the area, it is not the amount. We are just computing the amount. If we are just computing the area under normal curve, it is just area under normal curve. Okay. Why I am calculating? Because see beta, here I need to calculate the area under 1.8.75. Okay, the values available with me either of 1.87 or 1.88 from the table. If this value has been given in me in the question itself, then I need not to calculate it. But since in the table I only this value and this value is available is given, I have to calculate the same. Okay, okay, beta. Now I am coming to the last question of this session. This is question is adopted from the earlier examination. Okay, you just read out the question, then I got it solved for it. On Tuesday morning, before opening the capital market, an investor while going through his bank statement observed that an amount of rupees 7 lakh is lying in his bank account. Okay, this amount is available for use from Tuesday till Friday. Okay, the bank requires a minimum balance of rupees 1 lakh all times. Rupees 1,000, not 1 lakh, 1,000, my mistake. The investor desires to take maximum possible exposure in the capital in the market where the VaR should not exceed the balance lying is. So he get exposure means he can want to do some trading. Okay, as I told you, trading can be of a more amount also. Okay, the standard deviation of the index of the same market, 1.5%. So we can say it is a value standard deviation. Okay, index means the market index. Okay, which in which market he wants to trade. Per day, very important, it is a per day. The required confidence level is 99%, or he wants to confirm that 99% the chances are my even my accept 1000. Please note, accept 1000. How much amount I can be exposed for? 7 lakh minus 1000. So this is the amount I can play. 6,99,000 with the amount I can play. So he want to play with the market, okay, in the market, and he want to ensure that the value does not go. I want to not lose this value more than it, 6,99,000. And the standard deviation here is 1.5%. Okay, and he want 99% of confidence. Okay. Now how much trading or how much exposure he can take? Okay, let us solve it by in a tabular form, and each step from the each step you will get the answer very quickly. Okay, this was not though this question has come, it has shocked many students, but students please see how we have used. I will apply the simply the concept of the VaR that we have covered till now. Okay, first of all, amount available in bank account. So this is was 7 lakh rupees. Okay, the minimum balance to be kept it rupees 1000. Okay, so accordingly, the amount available which can be used for exposure in capital market. Now here the period will come for, now here see, I can use this amount Tuesday to Friday. So it means Tuesday, Wednesday, Thursday, and Friday. So there will be a period of 4 days. Okay, so I write here for the 4 days. Okay, so this much of amount I can use. Okay, or otherwise I can say that maximum amount of loss for the 4 days at 99% confidence level. So I am ready as an investor, I am ready to bear this much of loss. Now I have to decide what exposure I have to take. Okay. Now I convert this figure into 1 day because position has to take on a day wise. Okay, first day I have to take the position, so I have to convert it into the day 1 day. Because it says maximum possible exposure can take the, so it is on a 1 day basis. In the 4 day, I will lose this much of amount. Okay, so I have to compute it the for the 1 day because the loss will be start. I am assuming that loss will start from the day 1. Okay, how I will compute this amount? I will compute this amount 6,99,000 divided by square root of the 4. Okay, because in whenever we compute adjust the days in any VaR calculation, we use the square root. Okay, now corresponding Z score for 99% confidence level is 2.33. Okay, because it has been given in the table. Okay, or otherwise, see what happens generally. Uh, uh, you can keep it in the mind, or otherwise it is generally provided in the question how much. See, for I just give you very small hint that you keep this value in your mind. Generally for this 2.33 for 99% confidence level, okay, and 1.65 1.65, generally this value is used for 95% level of confidence. Okay, so you can use this score this 95% and this value for the, okay, just keep it this mind. There's only two values that you can use there. Sorry. Okay, now we compute. So this is the Z level. Now we compute the volatility in terms of rupees. Sorry. Before that, what I do, this is my Z level confidence. Okay, volatility in terms of rupees. How much risk I can bear? Okay, according to the same. Okay, at 99% level of confidence. Okay, but so what I do, this much of loss I can bear. Okay, so 3,49,500 divided by 2.33. Okay, so this is the debt score and this is this. So what I do, I compute the correspondingly because it is the opposite of VaR formula. VaR formula is standard deviation into Z score. So Z score is with me available. VaR is available with me because this much of loss, or we can say it is a VaR. Okay, so this VaR value is with me. Okay, now accordingly, I compute this value, standard deviation. Okay, the standard deviation value means this much of risk I can bear. This much of value wise I can lose my 3 lakh. This will be the value where I will lose in the 4 days. Okay, but the standard deviation or the risk is this maximum possible exposure. Okay, so what I do, volatility divided by standard deviation. Yeah, volatility, I just write it again. Volatility in terms of rupees divided by standard deviation. Okay, so the value comes it is because here one it is 1.5%. Okay, so here it comes 1 crore. Okay, student. So I can take the exposure of rupees 1 crore with this 6,99,000 in my hand. Okay. So you can see that in earlier questions with the standard deviation, we were moving to where. Here from where we are moving to the standard deviation or the exposure. Okay, student. Now with this, I come to the end of this session, and I hope the student the topics chapter number 1 and chapter number 2 must be very clear to you. Student, here I will like to share one thing with you also. ICAI is come has in a ICAI is issuing the journal. You know that there is a journal for the student as well. Okay, so for this you can also refer our capsules. Okay, for example, this is for the chapter 1. Okay, capsule is there. Okay, you can keep it for your issue, this issue for you, or in a soft form, or if the journal you are subscribing, you can keep a copy of the same, so that this can be helpful for you for your examination. Okay, so this was is from the March 2024 issue. Okay, for the risk management, you can even refer for the risk management, the issue, I think it is September 22. Although this issue is for the SFM paper, but there is no change in the risk management content. So you can also refer capsule of this paper risk management from there. Okay, student. So with this, so you can refer this capsule and keep strengthening your concept. Now, student, as usual, if you have any query, you can send us the query same at mobile app, or you can send your email as email at sfm-final @ICAI.in, or you can contact me over the telephone. This is STD code 0120 3045 956 at this number as well. So, student, with this, I come to the end of this lecture, and I thank you all for your patience listening. Student, some portion has been left in this our this is theoretical portion. As I told you, this is relating to a diagram. This is 1 second. Like as I told you, this is very small top some discussion. 1 second. Where we have completed now. These are the some topics or theoretical topics. You can refer these topics from the study material. Okay, I think you must have a very fair idea about the risk management. So you won't face any problem. Still, if you have face any problem, please do contact me. I will get clarified your concept. Where the recording is available, but it will be available on your BS Knowledge portal. Okay, don't worry, it will be available there. Okay, thank you, Jeannie, for appreciation of the lecture. Thank you, Nisha. Thank you, Nisha. Okay. Okay, Sahil, just you can get a recording available. If the recording takes place 1 or 2 days, they will make available to you. Don't worry. Okay. So you can even contact me over the telephone. Okay. Okay, student. Thank you. And student, one more important. In next class, we will start with the next topic, that is advanced capital budgeting decision. So my request to you, student, please brush your concept of simple capital budgeting. Okay, because here we will start with the advanced version. So my request to you, please, you go through the concept of advanced financial management basics there. Okay. So okay, student. See you in the next class. We will upload the assignment before the next class in 1 or 2 days. Okay. Okay. So student, thank you. Have a nice day. Thank you. Thanks a lot. Thank you. Okay. Thank you, Anila. Thank you. Thank you, Tushar. Okay, Ashok ji. Okay. Okay. Thank you.